Hello everybody, welcome back. This is episode number 14 of the Trading Bootcamp series, and in this episode we will be diving into what are market maker models. These can be market maker buy models or market maker sell models. I hope you guys enjoyed this video, and let's continue on with the video. Now, first things off, we will discuss what is a market maker X model, because this can be a buy or an S. That's why we have the X, because it can be both. We're gonna start off with the market maker buy model and then the market maker sell model. They're basically the same thing. One is just the inverse of the other and vice versa. And then at the end, I'll show you some chart examples and I'll do a brief overview of what we just went through. But this order is a little bit, is going to be changed, is going to be altered, just because the chart examples I'm going to show you as I'm showing you, for example, the market maker buy model. So I'm going to tell you what it is, I'm going to explain you, and then I will just pop up the charts so you guys can understand to the fullest what I'm talking about. So yeah, let's continue on and let's start with the market maker buy model. Now, before I actually start with the market maker model, I forgot I had to tell you guys what is a market maker's X model. So basically, as the name suggests, the triple M, as I like to call, is how basically markets move, because I don't know if you guys know, but markets basically move in curves. We have the sell side curve and then we have the buy side curve. That is how markets move every single time, because they are either in a downtrend or an uptrend, and those are basically the curves. And then you have in some place you have what's called a smart money reversal, which is when a curve diverges and the curve actually switches from, for example, being a sell side curve to being a buy side curve. And that is basically the trend switch that we all learned in the good old days. And maybe if you trade that, well, good for you. Now let's start with the market maker buy model. This is the one that is happening less frequently right now, just because of what the hell is going on, because I don't know if you guys know what's going on with the markets. Basically, it's going insane over Trump's decisions, over, I mean, everything in general, like the world in general, and that's why it's falling. Crypto's falling, Nasdaq is falling, as the ES is falling as well. Everything is falling, but I mean, there has to be a time to recover, and when that time happens, that is going to be that's going to be this. But now, before we move on, let's actually know these three things, because these are the red, the consolidation, and the green. That's what I like to call, to simplify things. Now let's start here with the red, because that's how time moves from left to right. And let's see, this red thing is called a sell side curve. So as I showed you guys previously, the sell side curve is actually the downtrend of the market. It's basically how the market is trending, and typically in the sell side curve, you want to actually be trading into the curve. Basically, you want to trade with the trend instead of against it. That is the most basic terminology of trading that we all learned, and you should keep doing that, because sometimes the basics are even better than the complex things that you're going to learn. And I'm talking with life too. But yeah, normally price, for example, you can see right here. Let's actually diverge a little bit from here, and let's move on to this, because this is the most important part. And before we move on to identifying the curves, this is actually the main thing that you need to know. It's actually knowing when the reversal to the new trend is going to happen. Now, normally you got this little period of consolidation. This is sometimes true and sometimes not true. Normally, in higher time frames, it is true. However, in lower time frames, it's normally within like 4 or 5. I don't want to say a specific number, but like in the range from 1 to 50, okay? From 1 to 50 candles, this usually happens. Therefore, this consolidation period that happens, basically the trend switch is normally pretty short on lower time frames, but it tends to get pretty big on higher time frames. And this is actually called a SMR. What does an SMR stand for? Smart money reversal. That is the definition for what it is. And it's basically when new smart money ends and basically swifts the trend from being, for example, in a bearish, in a downtrend, to being a bullish trend. And that is what we all learned. And yeah, that's basically the basics of trading, and yeah, that is really effective. And most people don't actually know this because I mean we all learn the basics, but then we kind of forget about them because we like the complex things. We like to complex things a little. But I mean, these basics, for example, the market maker model is really important, especially if you're a power 3-day trader like me. And then, of course, after the manipulation. And then, of course, after the reversal, you have, for example, for the market maker buy model, you have the sell side, and then the reversal from the sell side to the buy side of the curve. And I'm going to show you how it actually looks like. But I mean, as you guys can see right here, this is actually a really weird name. But I mean, I like to keep things simple, and this stands for original consolidation because, as I mentioned, this reversal is and can be a little original of consolidation. It can be from 1 to 50, around those numbers from the lower time frames, but on the higher it can be way much more. But now, how do I identify the curves? It's basically the trend. It's basically it. That's nothing else crazy to it. It's like you can literally draw on the chart. I'll show you a little bit on the chart examples, but this is so easy to identify because look, it's just you see ups and downs, but mostly downs, and that is your curve. That's basically it. Pretty simple and pretty understandable to get through. Now let's look into what it actually looks like to have this in the charts. Now I will start from left to right as I previously mentioned. So now let's start. This is the top. This is the main target that you normally want to be hitting with these trades that you're going to enter. Because it's the best thing that you can do. And then as you can see, you have these ups and downs, but mostly you have these downs because as you can see, you have lower highs, and lower highs forming, and then you have lower lows and lower lows, breaking those previous higher lows. That's basically meaning a curve. You can basically draw. It's like a bowl, you know? And yeah, how do I identify the smart money reversal? Well, usually the smart money reversal happens when price touches these two things that are pretty main, and I want you to write these down. The first one is the previous day high or low, because that is the highest and lowest traded point during that day, and usually price tends to reverse on those levels. And yeah, that's one of the things of the smart money reversal. And another thing, it is not as common, but it is just daily liquidity points. For example, it doesn't have to be previous day low and high. It can be like from 3 days before. It can be the high or the low, because these highs and lows from the daily are actually really powerful. And I actually know quite a few people that snipe these, and just so you can see how powerful they are. But now, before you actually enter blindly on these trades, you need to know you need to know like when did the reversal happen and if it actually is valid. Now, how do you know it is valid? It's just because of these two things. The first thing is not mandatory because, as you guys seen from my SMT video, I'm going to put it right here. As you guys seen from my SMT video, my smart money technique video, this is not a thing that you should enter upon. So if you see an SMT, you should not enter because you saw the SMT. The SMT, just like Michael, or if you guys don't know him, ICT himself, SMT, it stands for a confirmation. It's not a thing that you trade with. For example, fair value gaps. Fair value gaps are a thing that you trade with. SMT is just like more confirmation. I like to call it confidence. Like, you know, you get more confidence as you enter the trade. You get more confidence just because you have the SMT. You should not enter blindly just because you have that. And in this example, having the SMT is actually really good because it actually means that the two markets, for example, I'm using the Nasdaq right here, as you can see, but it can be ES or the Dow. They all move correlated, and basically when one diverges from one another, for example, when one sweeps a low and the other does not sweep a low, that is called the SMT divergence. And basically the two are diverging, therefore they need to put themselves back together. And how do they do that? Typically by reversing. And also the main thing and the thing that you should be focusing to confirm the smart money reversal is if you have the market structure shift, because as you've seen from my change state delivery video. I believe I talked about them. I do not believe I talked about the market structure shift, because they're basically the same thing as a change in state delivery. However, the change in state delivery usually happens in the 1 minute time frame, where you like to enter, where you like to enter your trades. And the market structure shift, it's basically when a candle body closure happens above a previous wick. That's basically it, and that is the market structure shift that you need to confirm a smart money reversal 100%. I don't want to say 100% because trading is probability, but I want to say 99% is going to happen. But now, how do you actually enter in these trades, and what can be your targets? Now, I got this little example, and as you guys should know, or as you guys know, I am a power 3-day trader. I like to trade. I like to take trades on the power 3, which is the accumulation, manipulation, distribution. They are three. I forgot the name. They are 3 words. That's why it's called the power 3, because they are really powerful and it happens every single day. And normally you can take these trades, as you can see from the sell side curve. You can enter once you have the fair value gap or an imbalance. Usually price tends to come back into it and then pump down or pump up back again. But normally it doesn't happen like this, because markets are not like this. They don't actually look like that, but they normally look more like this. That's why I have the example. They normally tend to accumulate, then manipulate to the fair value gap formed from the impulsive move of, for example, it's the buy side curve. And then they basically tap, they inverse, they create a change, and you can enter and you can ride all these. For example, you got the sell side curve and they are going to form lower highs. And those lower highs, once the sell side curve actually ends and reverses into the buy side curve, when you take trades on the buy side curve, you can and you should use these points as targets. That's basically it. Really, really simple. And yeah. Now, sorry, before I move on to that, I have to show you the examples. Now, this is pretty big, because normally I did not mention this also, but normally the market maker X model, or the market maker model, I'll just say that, it's easier. The market maker model usually happens within the day. So as I mentioned, this is really powerful because it happens every single fucking day. And it's the same thing every single day, as you can see, from Thursday to Friday. Look, Thursday, Friday, it is within 1 day. It can be more, it can be less. I mean, it is what it is. It's the markets, but typically it is around 1 day, because that's the daily candle that forms. And yeah, however, keep this in mind. For example, sometimes you got these huge daily, for example, you have these huge impulsive daily candles where, as I believe you guys saw, like, you got these huge daily candles. Normally when that happens, it usually means that price is just in the buy side curve and did not have the opportunity to inverse, to create that smart money reversal, to actually have the sell side curve inbound. And I mean, it can take more than a day, as I mentioned, but normally it happens around a day. Now, as you can see, this is pretty the same thing as you guys saw previously. You got the fair value gap, you got the accumulation, the manipulation, and then the distribution. That is the power 3. Pretty simple and pretty lovely, my strategy. Accumulation, manipulation. As you can see, price accumulates, manipulates, and distributes down lower. And look, as you can see, this is the sell side curve. And as I previously mentioned, you could literally draw on this because of how simple it is. Because look, it's a bull. And also, if you want to get technical here, you can't just be like, okay, so we got, for example, this high, and then this high is lower than this one, and then this one is lower than this one. Therefore, we're on the sell side curve. That is simple. That is another technical way to identify. I just like to be literally autistic and like draw a bull and say, bull, sell side curve. So yeah, it is pretty simple. And then, as you can see, smart money reversal happens. We have the this smart money reversal was actually to a too old day low. Sorry, I'm gagging a little. So you got the previous day low, and it was the day before that. It was that day's low, and price actually reversed from that one. How do you know that it reversed? I'm going to actually amplify it, guys, for you. You know that it reversed just because of this beautiful market structure shift that happened. And yeah, confirming. And in this case, we did not have the SMT. For example, the SMT could have happened. Sorry, the SMT could have happened here, or could have happened here. But these are just confirmations. Like if you don't have the SMT, you can still trade. It's just fine. And yeah, you can trade normally. And power 3 again, as you can see, accumulation, manipulation, distribution. Pretty simple, pretty average, pretty much what it is every single day. And yeah, that's a market maker buy model. And now let's look into his brother, which is the market maker sell model. I will not spend that much time in here because this is, as I mentioned previously, the same thing as the market maker buy model. It's just inversed, and I'll show you an example why. But basically, as you can see right here, it's the same thing. You got, instead of starting with the sell side curve, for example, instead of having lower highs and lower lows, you actually have higher highs and higher lows. That is how you know, or you can simply just draw an inverted bull and call it her sell side buy side curve. Yeah, that's how I like to do. I'm kind of autistic with these things. So yeah, you can get technical also, as I previously mentioned, by by spotting these higher highs and higher lows. But I mean, you don't need to get too complicated on the thing that you should know by, like, for example, when I backtest this, I usually use this as my daily profile, my daily bias, like, because I like to go on the trend. And basically, I can just spot that, and like I go on the 1 hour time frame, and then I just see like how price is moving. If I can draw a bull, then yeah, it's a curve. And yeah, I know my bias. You don't need to get technical with these basics. Now, you can see the same thing. Fuck my cough. So you have this, right? And then you have this, the SMR, and then you have this little period of consolidation before actually reversing and switching from this bullish trend to actually a bearish trend. Pretty simple. And yeah, there are also going to be targets that you could use, and also this. So I did not actually talk about this, but this high of consolidation. So let's look into example right here. This high of consolidation, which is this, is normally the previous day high in the market maker buy model. I'm sorry that I have to go back. It's just because of this example, but I'll show you on the market maker sell model just in a bit. But basically, this tippity top of the reversal is usually either the previous day high or the previous day low, just because of how common this is and how market moves, because it is literally market maker. That's how they do, and that's how it's done. And now let's look at the example. Same exact thing. And fuck, I'm bad. But yeah, you can actually see, and then I'll mention this too. For example, bull, inverted bull, same thing. But you got the power, you got the power 3 right here. You got the accumulation, the manipulation to the fair value gap, and then the distribution. Now in this case, since man, I'm sorry, my cough is really bad. I have asthma and my shit is starting to kicking. But yeah, I'll keep it short. So you got this accumulation, the manipulation, the distribution. And I showed you guys in the previous example, I showed you guys the market maker buy model, which is this. And I showed you a power 3 on this side, which is actually a thing that might confuse you, because you might think, oh, you can only trade on that curve. No, you just got to see the trend, but the targets are going to be a little bit different. For example, if you are on the buy side curve and you're forming the buy side curve, you can still trade the power 3, as you can see, because this is the sell model, but you can actually trade on the buy curve instead of the sell curve. It's preferably best the sell curve because of all of these targets right here down low. But if you actually decide to trade on the buy side curve, you can do so. Basically the same thing, same entry, inversion, changes the delivery, and you can either target, the safest thing is to target the accumulations high, or you can just look for that previous day high to target and also maybe reverse and catch another trade right here. Or, I mean, you can just chill out and actually avoid this, because if you know that price wants to reach a previous day high to actually reverse into the sell side curve, you can just wait, because waiting is the best thing that can happen in the stock market, and you should always do so. Stock market and Forex, sorry. But Yeah, same thing can happen here. It can happen in accumulation and manipulation and distribution. It's the exact same thing as the other one, and yeah, the entry and all the other stuff is all the same too. You got the SMD, the market structure shift to confirm, and then basically that's it, the same thing. And now let's look at the actual examples, which I believe it's right here. Where here, you can see this one was a little bit in post a little, because you can see this was a type period of consolidation. I mean, it's Monday. You can see down here, it is Monday, so this is a little accumulative. And then once New York opens, as you can see, 9:30, the impulse starts to kick in, and then it took a whole day, because as I showed you, this is called daily profile. It's actually your bias, and as you can see, it started on Monday and it ended on Tuesday, basically the whole day. And yeah, you can trade this. Look, accumulation, manipulation, distribution, same thing. And then this reversal, it was actually a reversal to the previous day high, but it took a little while because it's Monday. I mean, it's actually Tuesday right here, but this is Asia session in New York, in the NASDAQ. Yes, and the Dow tends to be a little accumulative, and hence why you can see that. But it's basically the sell side curve, or the inverted bull. You got the original consolidation to that SMR, or smart money reversal, and then you have all of these that you can use as targets. And look, another power 3 with the accumulation right here, the manipulation to this probably a value gap, and then lower. Yeah, that's basically everything that you need to know about the market maker model and about the market maker. Sorry, I just said one. But that is basically the exact same thing that you need to know for one another. They are the same thing. One is inverse from one another. That's why I like to call them brothers, because they're the same thing. It's just inverse. And yeah, that's everything that you need to know. That is, in summary, you got the sell side curve and the buy side curve. You got the original consolidation, which is the main thing that you want to be targeting. That is your original TP. But then to switch from the buy side or the sell side curve, you need to have the SMR, which then trend switches to the buy side curve or the sell side curve and this is your daily profile, because you should be using this as your daily profile. You should not be doing stuff like, if you're on a sell side curve, you don't want to be doing this. Try to catch trades on the opposite side, because 99% of the time you're just going to get stopped out and lose a trade, and you don't even know why, because it can be a A+ entry, but your daily profile, aka your bias, is extremely messed up. Now, I hope you guys enjoyed this video, and I hope you guys learned something new as well, because this is my daily profile. This is what I used to trade. This is what market makers actually trade with. And I hope you guys enjoyed this video in general, and God bless.